Good day to one and all. This is Dr. Sivaraman of iknowindices.com. I'll be presenting the monthly twin webinar tracking the forex market together. That is on July 17th. Part 1, now I am presenting between 9 and 9:45 GMT. And part 2, I will give it during that of the US session, 14 to 14:45 GMT. So, it is basically tracking the 24 hours forex market. So when you like to track the 24 hours forex market, it is extremely difficult to track all the 24 hours. So we need to find out how much of time we'll be able to watch and how many trades we can do, and will be able to identify the good trading opportunity, or we simply hold a position and wait for the market to move in our favor. So these things are to be taken into consideration in order to make the tracking more effective. So as the forex market is 24 hours market cycle from Monday to Friday, so if you start on Monday, then probably till Friday the chart will continue to move up and down, and we will not be in a position to really decide what is going to be the next move during that of the next 30 minutes or 1 hour during a session, or in a period of about 30-40 minutes, or after that of the data release. So we continue to have the confusions. What could be the possible move? And many of the people ask the simple question, whether euro up or down, whether GBP up or down. That's what they need to know, and they do not want to track by themselves. Instead, they want to know an easy solution. And if I say that it is going to be up, then they are willing to blindly buy and try to wait to exit out of the positions. So this is a normal condition you come across among that of the traders. But if you develop a system to track the market by ourselves, which gives enormous pleasure for us and understanding for us, and reduce our market surprises, and as a result the market fear goes off. So how exactly we can design it? So it should be a simple market tracking technique, and it should be effective. And also, after tracking the market, we need to have an effective trading strategies so that we are able to consistently earn from the market. There is no point in earning 50% of the occasions and losing 50% of the occasions. Then we only satisfy our quest to trade, but not really making money. So if you want to consistently make money as a professional or a full-time trader, then we need to develop a system. And I have developed a system of that nature, and I have given it in the form of webinars, my trading system, about a few years back. And now I'll explain to you how exactly the simple live market code page could be used as a tool to track the market. So before going to that of the live market code page, let me explain to you that the market is man-made. It is not the heavenly creation. It is man-made. So obviously when it is man-made, we'll come across certain hidden secrets behind the market. And we need to identify such things. And also when it is man-made, so men trade against men. So when people trade against each other, then we need to find out who is strong enough to handle the market. Then obviously the big money powers have got the capabilities of controlling the market. So we don't have such money power. So what you can do is simply find out or identify how the big money players or the market operators play in the market. So we need to read their hidden agenda and trade along with them instead of trying to fight against them. So they have a very simple system of fooling the traders day in and day out that create the market sentiment and act against the traders. This is a simple mechanism by which they continue to trap the traders, and they continue to earn from that of the traders when they lose. Either stopped out or without a stop, and getting the margin call, ultimately the traders predominantly lose money because they go with that of the market sentiment. And always there is a saying, go with that of the tide, go with that of the market sentiment. So they caught hold of it and they create the market sentiment and act against the traders. So what the traders can do, whether to follow the sentiments created in the market or whether to read the intentions of the players and trade accordingly. My simple suggestion could be, read the intentions of the players. Ultimately, they are the one playing against us. So if you want to really win in such a situation, then try to find out the weakness and the limitations of the players and try to play along with them, understanding their limitations, weaknesses, etc. So the players, for their convenience and depending upon the bank opening and the closing times, have divided the market, 24 hours market cycle, into 3 trading sessions. So I just use the terminology Japanese session, 0030 to 7:30 GMT and 7 GMT, and 7 to 7:30 GMT is the, so this was prepared before the daylight saving, so sorry, I didn't notice it. Okay. Then 7 to 7:30 GMT is the gap time. Then European session starts by 7:30 GMT and ends by 13 GMT. Then 13 to 13:30 GMT is the gap time, and the US session starts by 13:30 and gets over by 20:30 GMT. Now, what it means? So, the players know that the banks in certain regions open and close their trading hours, not the banking hours, the trading hours. So, based on that, they are just segregated into 3 sessions. And in between, there is a naturally occurring 30 minutes gap time. That means what? When predominant of the banks close in one region, the other banks in Europe to open, it will take about 30 minutes. So there is a gap. And this particular gap time, the official currency conversion trades will not start. It will be local 9:30 GMT. Local 9:30 AM. But before that, the banks in other regions would have closed. So in the gap time, they try to play a smart, cunning role. They try to hit the stops of the traders. So they try to use the gap time to make the false move in order to confuse the traders whether the market is going to rise or drop, and just to do the reverse during that of the start of the other session. So this is how they play the trick in the market. And I have been telling for the past 15 years about these tricks and about 11 years through FX Street. But still, they have not changed their strategy, because in the financial market, the only tool by which we can grab or earn money is act cunningly. Give false promises. Give enormous promises to the people that there will be enormous return and there could be enormous appreciation of your investment. Continue to invest and things like that. After about 6 months to 1 year, people will simply put the blame on the market. No, market is underperformed, so kindly shift your investment to some other instrument. So you'll be thinking, nobody can have control over the other market, so we need to shift from one instrument to another instrument. And when the market appreciates, there is no one to tell you that you book profit or just realize or exit out of the position or exit on the instruments, because invariably they know that the traders will be very greedy when they see that equity or the investment is appreciating, and the traders become worried when the long-term investors find that the equity is getting eroded. So, a typical example could be with regard to the gold. And when gold was appreciating, everybody was telling that, no, I just purchased gold, I am holding it, I will be very happy because it is phenomenally appreciated. Now everybody is worried whether the gold will go up or come down, go up or come down. So this is how they just create the hype and induce everybody to put all their money in one basket and subsequently find out whether they are going to shed rid or get rid of their investment and shift it to something else. So you come across there are various markets like the forex market, commodity markets and stock market and also the bond market, etc. They will always try to advise the people to shift from one market to another market and things like that. Ultimately, wherever you invest, we need to find out how the market is being manipulated and try to enter or exit in the market depending upon the opportunities given. So one need to understand that if the going is good, it doesn't mean that we can sleep over. So for that, as far as the intraday is concerned, we need to follow the market timings. So if you know the market timings, when exactly they are going to handle the market. So I explained during other webinars, Asian session webinar also, the first 30 minutes, first 1.5 hours from the start of the session and the last 1.5 hours towards the close of the sessions are called the early and the late sessions. And now, during that of the European session, 7:30 to 9 GMT is the early session and 11:30 to 13 GMT is the late session. During that of the early and the late sessions, they will be handling the majors. And during that of the mid sessions, they handle the crosses. So this we need to understand. At any given time, they will only handle 2 pairs at a time. And we need to find out what 2 pairs they are trying to handle and try to participate in that particular currency so that we will be able to earn nicely the money. So first of all, we need to understand the market timing. Then we have to use the live market code page. This is the code page wherein you come across the codes are given live and probably about 1 or 2 minutes, 15 seconds or so it is delayed, doesn't matter. But you have the 4 majors and 2 commodity pairs. So in these pairs, you have to find out at what level they have the bid and the ask and also what is the high they are set, what is the low they are set. So this is a 24 hours market. So in order to track it, we need to follow the GMT time frame. So this GMT time frame is very important. Since it is a 24 hours market, you should not track it like a 12-hour clock cycle because there is no morning and the evening as far as the GMT time is concerned. As far as GMT time is concerned, it is a 24 hours clock. So don't convert it into a 12-hour clock and say that 12 p.m. GMT or 2 p.m. GMT. That means you have not understood the GMT timing. So you have to say, conventionally people might be telling, but the correct expression will be 14 GMT or 13 GMT, like that. After 12 GMT, we have to continue to give it up to 24 as 15, 16 GMT. So you find the GMT starts, that market timing starts from that of the Japanese session and gets over by that of the late US session around 20:30 GMT. Then you come across the 4 hours gap time in order to have the next day start. So for that, it is very important to follow the GMT time. Then you come across another important factor, namely the high and the low. And this is the intraday high and the intraday low. So from 0000 GMT, what is the low they are set? And what is the high they are set is being shown in the live market code page. And in this, you have to find out currently at what level the market is. So now euro is 1.313 now. And the high is 1.3174 and the low is 1.3052. In this scenario, you come across it is in the middle level and not either closer to the low or closer to the high. And similarly, in the case of USD yen, it is in the middle level. 99.83 is the high, 99.09 is the low. In the case of GBP, it is 52.44, 52.79, 50.79 or the lows and the high. So it is in the middle level. So when it is in the middle level, there is no point in taking a position. So first of all, you have to identify whether it is closer to high or closer to low. Then secondly, you have to find out the net changes. So the net change is given in the same table. So euro is about 25 pips negative net change, and USD is 51 pips positive net change. Positive is given in green, negative is given in red. So GBP is 21 pips positive net change. So that means what? Euro is currently trading 23 pips lower than that of yesterday's close. So yesterday's close level, from there it has dropped about 23 pips currently. That is what it refers as the net change. So this net change is a vital tool for us to find out the limitations of the players. So the players at a given time or a day, they can drop or rise about 150 pips, nothing more than that. And if they rise straight away 150 pips in a given day on Monday, probably you know that, they just quickly gained 150 pips. And what is the point afterwards? They have to necessarily make a drop. So that is what you have to understand with regard to the limitations. And secondly, all quick moves are false moves in the market. Whenever they quickly gain the levels, in the case of GBP after 8:30 data release trigger, they quickly gained the level in notes in a few seconds. And what happened finally? You find that GBP started drifting downward. So the data might give that impression that GBP could continue to rise, but they are already gained from that of the negative net change to the positive net change during that of the early European session. So after booking profit, they will come down again and accumulate buy positions and then continue to rise during US session. So this we need to understand. So simply after the rise entering into the market or after the drop selling in the market is not the right approach. So what we do with the help of the live market code page. So we note down the initial lows and the highs set around the 3:30 GMT. So that I have it another slide. Okay. Now this slide I show it during that of the Asian session live market analysis on Mondays and Thursdays. So I noted down by 3:30 GMT what is the initial low and what is the initial high. They have set it. Now in the case of euro, 1.3052 is the low. Still that low is not been breached. But 1.3174 is the high. They have not breached it. Even though there was a data release, there was a quick move and things like that, they have not done it. In the case of GBP, because of the data, the low was 1.5108. They made the downward stockman and formed 1.5079 and came above and holding around 1.51. And they breached 1.5160, went about 80 pips, 1.5244, started making the drop. But what they will do, they will just hold it around above that of 1.5160 for another 15 to 20 minutes, and they slowly book profit after gaining the levels, and they will not breach 5160 because they sustained above that of the initial high for more than 30 minutes. You can watch and find out. So we will take a buy position around 5170 in the case of GBP, just 10 pips above that of the initial high, and keep about 30 pips below the hedging order to limit the risk and see what happens to the trade. So we recognize that it is a technical trade when they sustain above that of the initial high for more than 30 minutes during a session. That means they intend to gain the levels. That means they are trapped the short sellers and they want the trapped short sellers to come for short covering during that of the late session. Before that, they handle the crosses during the mid session. In the case of USD yen, 99.09 was the initial low and 99.55 was the initial high. They breached and went up to 99.83 and come down to 99.61. So still it is above 99.55. There is a likely chance that USD yen is also expected to go up along with that of GBP. You can see that both the USD yen and US GBP are showing positive net change. And GBP is showing positive net change and Euro is showing negative net change in order to drop Euro GBP cross. So they have been gaining on Monday and Tuesday, Euro GBP, and they started dropping Euro GBP by gaining more levels in the case of GBP and dropping more in the case of Euro. So this is the way they gain the levels and drop the levels in the case of the European crosses. Then in the case of USD CHF, again it is 93.91. 93.90 was the initial low, and 93.86 has become the new low, and 94.20 is the high. They just breached it. Gradually, they just made a brief upward and the downward stop, but still holding in positive net change. When GBP and USD CHF are holding positive net change or in the positive net change condition, that means they are handling GBP CHF cross. GBP CHF cross on the upside. So, by looking into it, you can tell, and you can also cross-check GBP CHF on the upside. They gained it. So, you can find out which pair they are handling at a given time, and accordingly, you can take positions. So, now it's a mid-sessions after 9 GMT, so they are handling the crosses. And in the case of USD CAD, is showing positive net change, and Australian dollar negative net change. That means they are making USD gaining move. Whereas here you come across that GBP is showing USD weakening move, and Yen is showing USD gaining move, Euro is showing USD gaining move, and CHF is showing nominal USD gaining move. So a mixed type of move is seen, which is referred as a contrarian move in order to handle the crosses. Then with regard to the Canadian dollar, 1.0368 is the low they set, and 1.0393 was the high, and they breached and formed 1.0408 as the new high. Then in the case of Australian dollar, a nominal upward move, they had done it, and they have come below that of the initial high. Then in the case of Australian dollar, 92.02 is the current level, and 92.18 was the initial low, but they breached and came down to 91.92, a psychological move below that of 0.9200, and just hit the stops which are placed below that of the psychological level 9200, and afterwards they are just holding around that, and 92.54 was the high, and they are not breached it. So you find that they are making the upward and the downward stop and move all the time in order to make money. So what you have to do is, whenever they make a downward stop and you have to find out it is only a stop and move and not an extended move or an intentional move continuously making a drop. How to find out the difference between such type of moves? So that is based on the time taken for the moves. So that is very important. For that, we need to use the GMT time frame. So, identify the types of moves. So, if a move is less than 30 minutes, then there are two conditions. One is a stop and move. This move, they will just go above that of the initial high. They just go above that of the initial high and drop to that of the initial high in less than 30 minutes. 8:30 they started, and 9:30 they have come closer to that. Nearly about an hour they are just taken. That is why I said more than 30 minutes they have been holding it. So it is not stoppant. If it comes below that initial low high in less than 30 minutes, then it is a stoppant. Then a false move is the one. They, in the case of Euro, they made it. They came up to that of 31.74 when GB was gaining the level, as if Euro is also going to gain as a mark based on market sentiment. And then they started making the slide. So they go up to that of the high and not breach the high and start making the slide is the false move. It can be on the downside also. They go up to that of the low, not breach the low and come above. That is also a false move. So normally such false move, they do it before that of the extended move. What is that? The moves which are more than 30 minutes up to 2 hours. So that is extended move. That means they cut the initial low and stay below that of the initial low for more than 30 minutes then continue to drop for 2 hours, and then reverse the market. And that is extended move. So how to differentiate a stop end from that of the extended move? In a stop end, they just go below that of the initial low, and in less than 30 minutes come above that of the initial low and stay above. That is stop end. Normally this stop end, they do it during that of the session start and session close times, or early and the late sessions. Whereas they just breach the initial low and stay below that initial low for more than 30 minutes. In the case of GBP, now they just breached the initial high, 1.5160, stayed above that initial high for more than 30 minutes. Then they will hold up to 2 hours. Okay? That is extended move. Now, how to differentiate this extended move? Then they reverse and come below that of the initial high and go below, if it is an extended move. But how to differentiate the extended move from that of the intentional move? Now, the intentional move is more than 2 hours. It is for 2 sessions and the start of the third session. That means from that of the Japanese session, if they start making the slide, they will continue to make the slide during that of the throughout the European session and make one quick downward move during start of the US session and then reverse the market. That is intentional move. So that can be on the downside. Similarly, on the upside, they breach the initial high and stay above that of the initial high and continue to rise for 2 hours and for 2 sessions, and then make one more upward move on the third session and then reverse. Start of the third session. So we need to find out whether it is an extended move or an intentional move. How to differentiate it? Extended move is always a quick move, and intentional move is a slow move. So in the extended move, they can just make 100 pips gain. Okay, they have done it first in the case of GBP. Now, they are holding for 1 hour above that of the initial high, 1.5160. And if they continue to hold above for more than 2 hours, then slowly if they gain the levels, that means it is an intentional move. That means the European session, they started breaching the initial high. So European and US session, they are expected to rise, and the start of the next day Japanese session. Till such time, they will continue to gain the level, even though the data was released around 8:30 GMT, and they will continue to bring the sentiment here up to that particular time frame, up to Japanese session. So that is what we need to understand. What is the intentional move and how it has to be differentiated from that of the extended move. Then swings are the one, they are the moves between the initial lows and the highs without breaching the high or the low. So these are all the main type of moves, and during trend reversal time, they make the extended stop and move. They just drop about 150 pips in a matter of about 1 or 2 hours, just reverse and come above that of the initial low in a matter of about 1 or 2 hours. That is extended stop and then continue to rise above that of the initial high, continue to gain the levels. And they may use any such excuse, a data release or just a breakout news. They can use it as a trigger and continue to gain or continue to drop the levels. This they mainly do it during that of the monthly trend reversal time. So in an intraday trade, we have to find out what move they are doing it of the 4 types of move, namely stop and false move, extended move, intentional move. Initially, the stop and false move, they tried swings, they tried to do it in order to induce the traders to commit positions. And after the traders commit position, when they find that predominant of the traders are long, let the data be so good, even then they will drop euro. And if all the traders have committed sell positions and the data from out of European region is bad, still they will rise. So now you can understand that the data release is used as an excuse. Ultimately, they can give any sort of interpretation for the data, and they can simply make an upward move and or a downward move. And what logic you have that GBP gained up from that of 1.5116 to 1.5244 in a matter of about 2 minutes, and then started making the slide. Okay, all of a sudden the data is being digested or it has been misinterpreted. Why it has dropped? So if you question that, the pip moves are not at all related to fundamentals or technicals, and they are based on the trader's commitment and also based on the trader's holding position, intent to hold the position, where the stops are, and things like that. Okay. Along with that of the type of moves, we need to understand the trading strategy. So if the hedging facility is available, use the hedge order in the same pair. Otherwise, use the stop. And the entry, we normally wait for 30 minutes from the session start time, from 7:30 to 8 GMT. And if they have done a brief downward stop, and try to pick up a position on the buy side. If they are near the high and just made a brief upward stop and reverse, we take a sell position. Otherwise, a technical trade, we buy above that of the initial high. If they hold above that of the initial high for more than 30 minutes. Similar in the case of GBP, they are holding above that of the initial high. Also in the case of USDN, they are holding above that of the initial high. So we can try to take a buy position, and they are expected to gain the levels. As you come across, both these things are showing positive net change. They will try to make an upward squeeze around 13 GMT. We can predict the market straight away by looking into the live market code page. We think that we have to do it only in the conventional way. Yeah, that is good, provided if the market is not manipulated. But when the market is manipulated, there is no point in justifying that the conventional method can still prove it, because we have to be smart enough or outsmart the players. Then exit. So if you take a position, buy position near that of the low, then we should try to exit near that of the high. And there comes our smartness. How? If they just quickly gain the level and stop cutting the new high for more than 30 minutes, quickly exit out of the position. Identify whether it is an extended move or an intentional move. So in the intentional move, we can just quickly book profit and re-enter near that of the initial high, and again book profit towards close of the session. We can identify two trades. And there is no need that every currency we need to take the positions. We have to find out which currency they are operating at the given time. And we have to enter into those currencies in order to make quick profit. And they handle only two currencies at a given time. I explained it many times. So, in the case, if you use hedging, and if the position is hedged, what we are supposed to do? Now, when a position is hedged, we have to watch for 10 to 30 minutes. If you become a smart trader, within 10 minutes, if it is making loss, you can close it. And otherwise, you can watch up to 30 minutes. And if the hedging is not at all making profit in 30 minutes of observation, simply close it with 5-10 pips loss and keep another hedging order below that. And once the market goes up, move it to the original hedging order level, so that you limit the risk only to 30 pips. And if it is hedged, doesn't mean that you are struck. We only use the hedge to find out whether the market has simply hedged during a stop end or during an extended move or during an intentional move. So we read the market, find out, okay, this is a stop end. Because of that, the hedging is making loss. 30 pips hedging order is making loss. Okay, close it and keep another hedging order. Okay, if the hedging is making profit, that means I failed to identify the stop end. Identify the extended move and took it as a stop point. So they hedged me and then start showing profit in the hedge side. Then I need not become worried. I can simply keep stop at entry. I know very well it could be either extended move on the downside or an intentional move for 2 sessions and the start of the 3rd session. They cannot continue to drop endlessly or rise endlessly, because they have to trap and earn money from that of the traders. Not simply showing the level is not their objective. So, when they show the profit in the hedging, then keep stop at the entry in the hedging order and wait for 2 hours to get over. Whether the new low is being breached or not. If the new low is not breached in 30 minutes of last 30 minutes observation after 2 hours, then you simply close the hedging with a nominal profit and keep stop or the hedging order below that and wait. They will start rising up to that of the initial high, low, and then continue to rise afterwards. Then you can move the hedging order upward and try to book profit on the upside also in the buy side. Then in case if it is an extra intentional move on the downside, the hedging is continuously making profit. So we have two options. We know that they will drop first session, second session, and a bigger drop during third session. Okay. So you identify after 2 hours that is intentional move because they are not attempted to come above that of the initial low at any given time in your observation of 2 hours. Fine. Then you simply close your buy position and maximize the profit and close the sell position during start of the US session. It is a simple trading strategy to get net profit on the same day. You might lose about 30-40 pips in the buy side, but on the sell side, if you earn about 70-80 pips, then you get about 40-50 pips profit straight. No, for that, we need to identify the type of moves properly. So hedging can be used for either way trading, as I explained it, on the buy side as well as the sell side. We can keep about 10 pips below that of the market. They buy order like 51.80. They will be filling it and taking it up. So it is around 90.93. I will keep a buy limit order at 10 pips below or probably 5 pips below because they have been coming to 51.85 and going above. So 51.85, the buy order I put, and exit will be 52.44. There is an initial high, and that's the exit or the limit order I intend to place. And in case if they come above that of 52 and gain, then I can move the limit order above. And you know that the net change they had done it at that moment is 73 pips. And when they came up to 52.44, it was about 75 pips. So in a given day, they can just gain about 100 to 150 pips. So another 75 pips, there is a potential for GBP to go up during the US session. In that case, I can simply move the exit limit above and above and try to earn or maximize the profit after keeping stop at entry and trail the stop, maintaining 30 pips below the market to start with and tighten it as 15 pips as we proceed. And when they stop cutting the new high, I'll tighten the trailing stop in the profit-making position. So that way you can maximize the profit. So the market can either hit your limit or the trailing stop, the profit is protected. So you need not become really afraid or worried and say that no, GBP has already gone up, there's no point in entering it. So let me enter into euro. There is no such logic in that market. You have to find out which pair is going to move, which pair they intend to make a move. So when they are keeping euro in negative net change and GBP in positive net change, they intend to drop euro GBP in a big way today. So which currency you have to bet? GBP on the buy side. Then afterwards, we can buy euro. There is no point in straight away taking euro position on a daily basis. And also in the case of USD yen, I explained to you the initial high was 99.55. So when it is 99.55, currently the market is around 99.59. So exactly above the initial high. Just 4 pips below, I'll keep the buy limit, and the exit will be 99.83 to start with. And if the going is good, we can continue to rise it. Then the stop will be 30 pips below, or the hedging order, 99.25. So I just taken two positions, and I'll try to explain to you during that of the second part what happened to these positions. Now GBP still they are not filling it up. I could have taken it around 51.90. Doesn't matter. They will make a downward before making further rise. So they are just what they are trying to do is hold above that of the initial high, and they swing near that. So people will think that, okay, we missed selling at 52.44, and when it is below that of the pivot point or below that of the resistance, then people think that, okay, you can sell. We can sell for about 5 pips or 10 pips. But they are going to hold above 51.60 and probably 51.65, 51.70 they may come down to and then quickly reverse. So that is why 51.85 I kept the order 10 pips below that of the market. Let us see how they are filling it. Otherwise, I wait for the next session and find out what is the market move they are trying to make and choose that particular currency and take the position. So this is how we have to decide as far as my trading system is concerned. Identify the type of move and try to enter when the market during that of the early and the late sessions, late period of the sessions, when you are trading in majors and when you are trading in the crosses, then choose the middle session, mid-European or mid-US session, so that you will be able to really or quickly book profit within the session. Then also, we identify what side of trade we can do. Either a basic trade of buy near low or sell near high, or sell near high and buy near low, or a technical trade, buy above that of the initial high and book profit on the same day, or sell below that of the initial low and book profit on the same day, based on the type of moves. So if you could follow that, then you will find that trading becomes a simple technique. And it is ultimately a game to read other man's mind and trade along with that mighty personality. Nothing more than that. So we have to find out how the players are manipulating the market, what they can do. They can act only cunningly against us. Okay, identify the cunningness. Identify the cunningness, then you will find that we can easily earn from that of the person. Okay, stop loss in the case of GBP will be 30 pips below, 1.51. So if you've got any questions, you can ask me. I'll answer to those questions. I have only a few minutes left. Okay. Then, Gino, what is the situation in India with gold? People are happy with the cheap gold? No. I will not be able to comment on larger Indian population. But see, Indians have got a different sentiment. They think that gold is a commodity which can be easily liquidated at the event of crisis. So they continue to invest in gold. And they are all position traders. They don't take leverage position. They buy physical gold and store it. It is conventionally, it is a practice among Indians. Then Hansen, what about stop loss? I just mentioned stop loss in the case of GBP. Sorry, I did not put it earlier. Yeah, it is always 30 pips as far as majors are concerned, because, so you should have a reason why we have 30 pips. No, they make the swings in the market. They make the swings for 15 pips. That is why 10 pips below the market, I try to keep the buy order. Okay. Now here, they might fill, but GBP is already gone up. And again, they will make a dip before the late session. So at that time, my buy will be filled, and afterwards we can book profit. So what we need to understand, the market main swings. They make about 5 to 10 pips swing and a maximum of 23 pips swing, because 3 pips is the spread. So 20 pips they make and 3 pips will be the spread up to which your platform can hit your stop. Then if you keep 30 pips, if it's a honest platform provider, then your stop or hedge order should not be filled, but dishonest people can fill it. So I cannot guarantee that. So that is why we have to keep 30 pips hedge order, just 7 pips above that of the 23 pips swing. So it is unlikely the stop will be filled. We can simply keep the stop below that of the pivot point or above that of the resistance, all those things. But ultimately, in the event if the stop is filled, whether we are in a position to accept a loss, that is the most important thing. Now, anybody for that matter, when you trade, they recommend stop. But the stop should be bearable. So if the stop is about 20-30 pips, sometimes even 5-10 pips tight stops, fine. We can absorb the loss. But if we keep about 70 pips stop and try to aim for about 200 pips profit and say that I got the risk reward ratio of 1:3, no. If they hit your 70 pips stop, whether you will be able to withstand the loss, we have to find out. Okay. Then what about Euro USD entry exit positions? Euro at the moment they are just making only the swings, as I told you, and it is making only a swing near that of the high. So when they come closer to that of the high and not breach the high, we can only take a sell. And when they make a drop, we can buy it. No, if they breach the high and stay above, then we can take a technical buy if they stay above that of the initial high for more than 30 minutes. And it is not closer to low to take a buy. So I will not enter into euro at the current situation. Even though it may move about 30-40 pips, but I am not interested in such risky trades. I want to have a clear understanding of the market moves, and if they are doing that properly, and I have to find out which currency they are handling. These two pairs they are handling. So in these two pairs only, if I take position, I'll be able to book profit. If I simply take in euro, I may simply hold it till the next session. What is the use? I wanted to make money. I don't have any sentimental attachment to any currency pair. Then call. Can I have those slides? Yeah, these slides are being, and the webinar is being recorded, and you will be able to see the slides in the recorded webinar. Okay. Yes. Okay. No more questions here. So let me wind up with the help of the live market code page. So we identify the initial highs and the lows around 3:30 GMT during that of the Japanese session. In the event if you are not able to watch the Japanese session, you can just note down from the chart or any other feed what was the initial high and the low around 3:30 GMT. And then compare whether the initial lows and the highs are altered or the same during that of the European session, in case we are not able to watch the Japanese session. Because it is next to impossible to watch all the three sessions. So obviously you have to develop a method, and you have to see that you don't strain yourself much. If you strain, your thinking ability comes down. Then automatically you become addicted to trading. So avoid that. So without any strain and the constraint, or without any stress, try to trade. You will be able to have a better understanding of the market, earn nicely from that of the market. Then afterwards, follow the GMT time frame, that the initial lows and the highs, how they are, whether the market is near the high or low. Then try to think of the trade plan. To buy near that of the low, when the low is not being breached for more than 30 minutes, sell near that of the high, when the high is not being breached for more than 30 minutes from your observation. Then afterwards, try to close within the session as a session-wide trade. So that is what I said, that I am initiating the trades here, and this is only an order still. This they are not filled. Both they are not filled. I have put the order. And if they don't fill it in 30 minutes of my observation, I just modify and pick up from the market. When they make a small dip, not when they are making a firming up. When they show red, and then I'll try to take a buy. Because that is how they sell and induce the traders to sell and buy. They buy when the traders sell. So when they show red codes, then I try to buy along with them when they are buying it. And when they show green, exit out of the position, I just exit my positions also. So trade along with them. So these are all the two currencies I identify because they are operating at the given time, these two currencies. So all the other currencies, they are simply holding it. Okay. So I will come back again by by 14 GMT. I'll come by 14 GMT and explain to you what happened to the positions, what I have taken or what I have orders I have placed during this particular session, and the outcome of it, how I handle that particular position. If it is hedged, I'll explain to you. And also I'll review the market during the early US session. So US session starts by 13 GMT. So 13:30 GMT. It will be exactly 30 minutes past the start of the US session. So we'll have a great trading opportunity during that time. I'll explain to you again how we can enter and exit out of the positions. And till such time, kindly use the live market code page and track from 9:45 up to 14 GMT. Find out what I have said is coming true or not in the market. And we'll come back and have more interactions. So if you find that this is useful, and try to fine tune it using your own observations and then develop a method of trading for yourself. Thank you one and all. See you by 14 GMT.